Okay, so here are a few slides dealing with one or two revision points that you may or may not find useful as a memory jog at the last moment before the exam. Personally, I think one of the best ways of last minute revision is to work through the textbook and just have a look at the charts that are included at the beginning of each chapter. I think those are a really useful summary of the main points that are included. If you look at those charts and you see something that you think you don't really know about, then that's an indication that you need to go and read a few pages in the text. So I'd really encourage you to work through those and have a look at those. But the following slides might help a bit as a final reminder too. But I'm sure from the work I've seen so far that you're all going to do pretty well, particularly in the calculation questions. Just spend a bit of time working on those accounting standards and questions 4 and 5, where students generally tend to lose marks, sometimes unnecessarily. So have a look at these, see if they're a help, and good luck. So the first two questions in the exam will either be a straightforward single company profit and loss account and statement of financial position, or it will be the completion of a cash flow and a statement of changes in equity of a company. One of those two options, you may or may not have a preference to those two. Okay, so just a quick reminder about accruals and prepayments. Make sure you don't get them the wrong way round. If the amounts entered or paid after the balance sheet date, then you're going to need to add in an accrual for the part of the expense up to the year end. If the amounts entered and paid before the end of the year, then the adjustment's going to be a prepayment for the part of the expense that relates to periods after the year end. Make sure you calculate the correct part of the payment to adjust. If it's an accrual, then remember to add the accruals to the trade payables figure in the statement of financial position. It's just one figure, and prepayments, they get added to trade receivables in the current assets. So here's a couple of quick questions. Year-end 30th September 2020, a payments made in November 2020 for £900 to cover electricity used between the 1st of August and the 30th of October. Now this payment is after the end of the year, so just work out what the adjustment will be. And in this case, we need to include the cost of the electricity used from the 1st of August up to the year end, 30th of September. So it's 2 months out of that 3-month bill. So we need to increase our admin expenses by 600 and create an accrual that will be included with the trade payables figure. And another quick question, year ended 30th September 2020 again. This time the payment's made before the year end. It's made in August 2020 for £1,800 insurance, covering the period from the 1st of July 2020 to the 30th of June 2021. So just work out what the adjustment will be in this case, and pause the video while you're doing that. So in this case, we need to make an adjustment for the part of the expense that relates to the benefits that are going to be used up next year. That's why it's treated as an asset at the balance sheet date. So the period from the 1st of October 2020 to the 30th of June 2021 is the amount of the prepayment. That's 9/12 of the £1,800, which is 1,350. That will be debited to prepayments, and it will reduce admin expenses by 1,350 in profit and loss. And as the slide says, just note that the date of payment is to some extent irrelevant. It's the date that the benefits will be used up that's important, i.e. the 1st of July to the 30th of June. The fact that payment was made in August doesn't make any difference to the calculation as long as it was before the year end. And a quick reminder about the profit and loss account. The revenue figure, don't forget to deduct returns inwards if that account appears in the trial balance. And cost of sales, remember, opening stock plus purchases minus returns outwards if there are any, minus closing stock will give you your cost of sales figure. And interest, if there's an account in the trial balance with a debit balance, that's the interest that's already been paid in the period. Any accrual that you need to make gets added to that figure. And in the balance sheet, statement of financial position, property, plant and equipment, remember under IAS 1, just one figure is shown for all tangible non-current assets. So land and buildings, plant and machinery, all added together in just one figure of the net book value. Current assets, it's worth making sure that you list those in reverse order of liquidity. So first of all, put in the value of inventory, followed by trade and other payables, and finally bank and cash. That's the order that they will normally appear in. Retained earnings, please do not use the trial balance figure. Remember, you've got to take the opening balance from the trial balance, but you've then got to add on to that the profit that you've calculated for the year, or deduct the loss if there's a loss for the year, and then deduct all dividends paid in the year. So any dividend account with a debit balance in the trial balance needs to be deducted from the retained earnings figure. It doesn't matter what period the dividends relate to. That will give you the retained earnings figure that goes into the statement of financial position. And here's the notes about the cash flow. Just remember with the cash flow that you can always work out before you do anything. You can work out what your answer's got to be by comparing the cash at the beginning and end of the year. Just watch out for overdrafts when you're doing that. First thing to do with the cash flow question is to look carefully at the profit and loss account, and remember that you're dealing with cash in the cash flow. So anything that's not going to result in money going into or out of the bank account, we need to make an adjustment for. So have a look at the profit and loss account to identify any items that need to be adjusting. If there's a profit on sale included, that's got to be deducted from the profit figure. If there's a loss on sale, you've got to add it to the profit figure. If there's an increase in provision for doubtful debts, add that to the profit. If there's a reduction in the provision, deduct it. That's unlikely to crop up. It's more likely to be a profit or a loss on sale, but remember to make the adjustment the right way round for those. Also check the starting point of the cash flow. I've mentioned this a few times in the mock exams. If you are asked to start with the operating profit in the exam, then you don't need to make any additional adjustments. But if you're asked to start with the profit before tax figure, and that might actually be put into the cash flow for you, If you're asked to start with the profit before tax, then remember you've got to add back the finance costs from the profit and loss account before they're deducted later on. So you're effectively working back to the operating profit anyway, but just watch out for that. And the movements in current assets and current liabilities is the area where people tend to get the additions and deductions the wrong way around. Remember, with trade receivables, if trade receivables have increased, that means more money is owing. That means we've received less money into the bank account. So that's going to reduce the money in the bank. So that's a negative outflow. If trade receivables have gone down, that means more customers have paid. That means more money's gone into the bank. And so that's a positive inflow. But with trade payables, it's the other way around. If trade payables have gone up, that means that we owe more money and therefore we've paid less out of the bank. So that's going to increase the bank balance. So that's a positive figure. But if trade payables has gone down, we owe less, so we've paid more. That's money gone out of the bank. That's a negative figure. And then finally, inventory. If inventory's gone down, that means that we've used up stock that we already had, and therefore there's no need to make any purchase. So there won't be money going out of the bank account. That's a positive addition to the amount of money in the bank, so that's an inflow. If stock's gone up, then yes, we've needed to purchase more, so the money's gone out of the bank account. So make sure you get those three adjustments the right way around in your calculation of operating cash flow. And remember, one of the last deductions in the operating cash flow is the tax paid figure. And remember, it's the tax paid in the period, not the figure in the profit and loss account. And so it will often be the opening tax liability in last year's balance sheet that will be the correct figure, but you should double check that and carry out this calculation. Take the opening creditor, add on the charge to the profit and loss for the year, and deduct the closing liability from the current year's balance sheet. That will give you the amount paid figure, and very often it will equal the opening liability, but it's worth to double check that. I just mentioned there deferred tax. If there is a deferred tax charge, it's extremely unlikely that that will happen, but then that should be ignored and deducted from the charge in the profit and loss account because it doesn't relate to actual tax payments. Investing activities, remember the main things are going to be purchases and sales of assets, and sometimes in the exam this is the only calculation relating to the cash flow that you'll need to carry out. And it's a bit like an incomplete records calculation. We know the opening carrying amount of property, plant and equipment. The depreciation charge will be a deduction from that. If there's a revaluation in the year, that will have increased the balance sheet figure, but as the slide says, that's unlikely to appear in the exam. The depreciation charge for the year will certainly be there. That's going to reduce the balance sheet figure. The book value, not the sale proceeds, but the net book value of any assets disposed of in the year should be deducted from the opening figure, and that would give us the closing figure were it not for purchases in the period. And so that balancing figure in this calculation will be the amount of purchases during the year. Sale proceeds, remember we're dealing with cash, so any sales are going to be an inflow of money into the bank account. Get the calculations the right way round. If there's a profit on disposal, then you need to add that profit to the net book value to get the amount that's paid into the bank account. If there's a loss on disposal, then that needs to be deducted. And financing activities, remember, if loans and share capital have increased, then that's going to result in money going into the bank account. Don't forget with movements in share capital to include any movement on the share premium account in the calculation. Reductions in long-term loans will be an outflow of cash. And don't forget dividends paid in the period to shareholders. That goes into the financing activities section as an outflow of cash from the bank account. Dividends received on investments will go into the investing activities section. Question 3 is always going to be a question on the conceptual framework and international accounting standards generally, along with a few bits and pieces regarding ethics. So make sure you go through these and you remember the definitions and so on to help you with question 3. In question 3, you're often asked to state what the objectives are. Now you need to be really careful about which definition the question is asking you for. If the question asks you for the objective of general purpose financial reporting, that's the definition that comes from the conceptual framework, and it's this one: to provide financial information about the reporting entity that's useful to existing and potential investors, lenders and other creditors in making decisions about providing resources to the entity. That's the conceptual framework objective of financial reporting. If, however, the question asks you to state the objective of general purpose financial statements, then the definition's much more specific, and it's this one: to provide information about the financial position, balance sheet, financial performance, profit and loss, and cash flows of an entity that is useful to a wide range of users in making economic decisions. So don't confuse those two, but the important thing is that you include the fact that it's providing information that's useful in making decisions about investment. That's the crucial thing in both of those definitions. Qualitative characteristics you'll often be asked for either as a tick box question, or you might be asked to explain what some of them mean. You need to be able to do that. Have a look in the textbook if you're not sure. Relevance, faithful representation, those are the two main ones, and then the enhancing characteristics: comparability, verifiability, timeliness and understandability. Make sure you can remember those and at least write something about each of the 6, what they mean. Relevance, remember, we only want to include items that could affect investment decisions. We don't include lots of superfluous information. And faithful representation means that the accounts show a true and fair view, that they're not presented in some way that could mislead people into drawing wrong conclusions about how well the company is doing. And the main underlying assumption when the accounts are being prepared is that the company will continue as a going concern, and that means that we expect the business to continue for at least another 12 months after the period end. If there's any doubt about the ability of the company to continue because it's making losses or because its liabilities exceed its assets, then the statement of financial position must be prepared on a different basis, and all of the assets must then be shown at their estimated disposal proceeds, because there will no longer be a value in use if the business is going to discontinue. And as the slide says, the effect on share prices would obviously be dramatic if we're talking about a quoted company, and so the directors will be very keen to try and put forward arguments to support the fact that no matter how bad things are, the company will be able to continue in the foreseeable future. And there's just an example of one of those notes. This is Whitbread's, and you'll see that the directors have included in accounting policies the final paragraph there. The consolidated financial statements have been prepared on a going concern basis. Further details contained in the viability statement. So they've gone into a lot of detail explaining why they think, irrespective of the current situation, why the company's certain to continue, and the auditors have to report on that as well. And there's an example of the auditors' report to Whitbread and what they've done to consider whether it's appropriate for the accounts to be prepared on a going concern basis. The 5 elements that are in the financial statements as defined in the conceptual framework, you must be able to give a brief definition of each one of these. Assets, remember, the important thing is that there's got to be a future economic benefit. If there's no future benefit, there's no asset. And we can only include an asset if the cost can be reliably determined. Liabilities, the important thing is that there must be an obligation at the the balance sheet date, and that can be a legal obligation if there's a signed document, or it can be a constructive obligation arising from past behavior of the company. And most importantly, it's more likely than not that a payment will be required. If it's more than 50% certain that we're going to have to make a payment or at least use up cash to satisfy that liability, then it goes into the statement of financial position. Equity, remember the definition is straight out of the accounting equation. It's assets minus liabilities. Income, we only include income in the balance sheet if the other half of the double entry is going to increase equity in the balance sheet. And expenses, we only include an expense in the profit and loss account if that item, the double entry, is going to reduce equity in the balance sheet. So you need to be able to give brief explanations and definitions of those. Acceptable valuation methods for the accounts. Remember, normally accounts will be prepared on an historic cost basis, but there are other bases that are allowable under the conceptual framework. Current cost, that's where assets are shown at their replacement cost, and that's not the cost of replacing an old machine with a brand new one, it's the cost of replacing an old machine with an equivalent old machine, what price you would have to pay to buy the equivalent with the same amount of wear and tear off of eBay or something. Realizable value is what it could be sold for, and that's the value that must be used if the business isn't a going concern. So all assets have to be stated up. The future benefit that's going to be received from those assets, which in that case is just going to be the sale proceeds. And finally, present value, that's the discounted value of future profits that we think are going to be generated as a result of using that particular asset. So all of those bases are allowable under the conceptual framework, but nearly all companies will use historic cost subject to the revaluation of some non-current assets. In question 3, you might also get some ethics questions. 2 things to remember: AAT's fundamental principles, integrity, you've got to be straightforward in your dealings and business. Objectivity, professional skepticism is the phrase to remember. You don't just accept what people tell you without questioning, without asking, could this be correct, could this be wrong? You've got to be objective as far as dealing with information that's provided to you, particularly by directors. Professional competence and due care, don't undertake work that you're not competent to do. As I've sometimes mentioned before, farmers have special accounting rules, artists and performers have special accounting rules. If you've never dealt with farmers or celebrities, then you might not have the knowledge that would enable you to do the work properly for them. So you only undertake work that you're competent to do. Confidentiality, you don't tell anybody, not the client's husband or wife, and certainly not HM Revenue and Customs unless you get a formal request from HMRC to disclose the information. And professional behaviour, you don't want to behave in a way that would bring the profession into disrepute. So that's AAT's fundamental principles that crops up sometimes. The other ethical item that might crop up are the risks to independence of an accountant. And remember, self-interest. If you've got shares in a company, then you might be reluctant to show that the company is not doing very well and making a loss. So that could affect you personally, and you might be tempted to present figures that are incorrect, that you're personally going to benefit from. Self-review, don't check your own work, somebody else needs to check it for you. Advocacy, if you've been telling people that the company you work for is really good and they should invest money in it, and the accounts show that it's losing money, that might not look very good on your part, and so you might be tempted to show in the accounts that things are better than is actually the case. Familiarity, personal relationships with the directors might tempt you to adjust the accounts to make things look better than they really are. And intimidation, if you're told that you're going to lose your job or you're going to lose the income from this work if you don't make adjustments in a particular way, that could be a threat to independence. So those are the 5 things there: self-interest, self-review, advocacy, familiarity and intimidation, that might also crop up in question 3. Now these are the 2 questions along with question 8 where students lose marks in the exam, and out of all the chapters in the textbook, the ones that I would really encourage you to work through all of the examples are the chapters dealing with accounting standards, and I'll go through some of the main points with a few example questions in the following slides. Now, when it comes to accounting standards, it's the written questions where students tend to lose marks, unfortunately. And you can avoid that if, when you've read through the question, just ask yourself, what is this question testing my knowledge of? Which accounting standard am I being tested on in this written question? And once you've decided that, you need to make sure that whatever you write demonstrates your knowledge of that particular accounting standard, that you know all the rules and so on relating to that particular accounting standard. But you then need to look at how those rules affect the scenario that's included in the question, and you need to make sure after you've shown that you know what the rules are, you must then show that you can apply them to the situation in the question. So you've got to do both. You will lose a lot of marks if you state the rules and don't apply them to the situation in question, but you'll also lose a lot of marks if you simply write an answer saying what the correct treatment is in a particular case without explaining why it has to be treated in that particular way. So you've got to demonstrate that you know the rules, and you've got to demonstrate that you can then apply them to a particular question. So IAS 2 inventory will inevitably crop up in questions 4 and 5. Remember, the cost figure of inventory must not be determined on a LIFO basis. That's not allowed under IAS 2. And when you determine cost, you must include all costs, as the slide says, necessary to bring items to their present location and condition, delivery costs and so on. The important thing to remember is that production overheads have to be included in that cost figure. So we're looking at absorption costing methods. Those production overheads have to be absorbed into the cost of our stock, and they're allocated on the basis of normal levels of production. And under IAS 2, we have to compare cost to net realizable value. This will sometimes be the selling price, but not always. Don't make the mistake of just looking at the selling price. The net realizable value is the selling price less costs to complete and costs to sell. Don't make the mistake of adding those to the cost figure. The cost to complete, cost to sell get deducted from the selling price to arrive at net realizable value. And then we value our stock at the lower of those two figures on an item by item basis. So here's a quick question. In a particular year, a company that usually produces 10,000 units only manages to produce 8,000 because of a machine breakdown. Factory overhead costs in the year amounted to £16,000, and at the end of the year 2,000 complete units were still in stock. Remember, if the units are only half complete, you have to convert them into the equivalent number of completed units. So if these 2,000 units were only 50% complete, that would make a completed equivalent of 1,000 units. But in this question, there are 2,000 completed units still in stock. So you need to work out what overheads you will include in the cost figure of those 2,000 units. Just pause the video and then see if you can work that out. So in this case, the factory overheads are 16,000. That's divided over units according to normal levels of production, which is 10,000 units. 2,000 of those are still in stock, and so that gives us a figure of £3,200 that we will include in the cost of those 2,000 units. So that's an apportionment based on normal levels of production. And obviously that's in addition to purchase costs, delivery costs, and so on. And here's the sort of question that you might get in the exam. You've got a column giving cost determined on a first in, first out basis, cost determined on a last in, first out basis, costs necessary to complete those products ready to sell, and costs related to the selling of the products, and finally the selling price. So just pause this presentation for a moment and see if you can work out what the total stock value will be under IAS 2 based on the figures shown there. Right, so the first thing we can do is to get rid of the LIFO column. That's completely irrelevant. We don't need to do anything with that. It can be completely ignored. The next thing we need to do is to work out the net realizable value, and remember that's the selling price minus costs to sell and costs to complete. Don't make the mistake of adding those figures together. It's the selling price minus cost to complete minus cost to sell. That gives us the net realizable value, and those are the two figures that we compare item by item to work out our closing stock value, which you should have as £7,580. So ignore LIFO, cost to complete and cost to sell. Do not add them to the cost figure, deduct them from the selling price. IAS 10, events after the reporting period. The investors need to know about those, and remember we're looking at the period between the period end, the balance sheet date, and the date the directors approve the accounts for issue. It's items that happen during that period that can affect investment decisions that we need to deal with, and they can fall into one of two categories: either an adjusting event, and that's really the discovery of new detailed information about the position that existed at the period end. We're discovering things that we didn't know before that can affect the value of assets and liabilities at the year-end date. And adjusting events require a change to the accounts before they're issued to the shareholders. Non-adjusting events are things that happen after the year end that could affect investment decisions but don't affect the company's balance sheet position at the year end. But because they can affect investment decisions, they need to be included in the accounts as a note, but not as an adjustment to the statement of financial position. And here are examples of items that you might need to determine which category they fall into in the exam. If after the year end and before the accounts are signed off by the directors, you discover that there are faults in the stock that was on the shelves at the year end that requires extra work, or means that you can't sell them for the normal selling price, that's an adjusting event because we've discovered more information about the value of the stock at the year end. And so we need to reduce that stock then to its net realizable value and adjust the balance sheet for that. If we discover after the year end that a customer that owed us money at the balance sheet date is unable to pay, that's an adjusting event, assuming that the customer wasn't in a position to pay at the year end date. So that would require an increase in the provision for doubtful debts. Fire destroying stock after the year end. That's a non-adjusting event. The stock was on our shelves at the year end, full value at the year end, so no adjustment to the balance sheet date asset value, but it's obviously an important event, and so it will need to be mentioned in a note to the accounts. Change in the market, if there's a change in the market for our products, which means that we can't sell them for the price that we expected, that will be an adjusting event, or at least potentially an adjusting event if the selling price is now below cost, because we would have to adjust our stock to net realizable value. An outbreak of a pandemic after the year end, that would be a non-adjusting event, because it will only have an impact on future business. It doesn't affect what the situation was at the date we drew up the balance sheet. The only time it could require an adjustment to the accounts is when it's considered that the business is no longer a going concern as a result of that, but that's unlikely to crop up. Introduction of new rules that could affect the company's business. If the new rules weren't introduced until after the year end, that will be a non-adjusting event that needs to be reported in the accounts but not adjusted in the balance sheet. And if there was an ongoing court case and we thought we were going to win and ultimately we lose the case, then that will mean that that's an adjusting event, because there's a new liability that we weren't including previously on the basis that it was only contingent, but we now know it's a real liability, and so we've got to make adjustments to the accounts. So those are the kind of things that might crop up in the exam. IAS 12 is fairly straightforward. There's a small amount in the books about IAS 12. Clearly, when we put in a provision for tax payments into the profit and loss account, it is only a provision and an estimate. Very often the actual amount payable will be sometimes more, sometimes less than that. Once that difference has been identified, then the difference will go to profit and loss along with the estimated tax charge for the year. Deferred tax won't crop up in a big way. You should know by now that the profit on which tax is charged is rarely, if ever, the accounts profit. And that means that the tax charge could be distorted in some ways to give an incorrect view of how the business is doing. And so companies will tend to put through a deferred tax charge, which represents the tax that will ultimately be payable on profits that are included in the accounts that aren't currently being taxed. That's really as much as you need to know about it for this exam. So the tax charge in the profit and loss account could be made up of the current year's estimated tax liability, then an adjustment for any over or underestimate of tax liability in previous periods, and potentially a deferred tax adjustment that could give the total charge to profit and loss. But don't worry too much about that. It's unlikely to be a major item in the exam. IAS 16, however, is likely to be a major part of the exam, and it's important to remember all the elements of that. An asset included under IAS 16 is only an asset if there's going to be a future economic benefit, and it's the future benefit that we're going to obtain. That's really the asset, not the physical item itself. And the cost of the asset, remember, we have to include all costs up to the point where the item is ready to be used in the business. So that will include obviously the purchase price, but also the cost of delivery, the cost of installation, the cost of modifying the premises if necessary to incorporate that asset in the business, and so on. So any costs that were necessary to get that particular item to the point where it's usable in the business. But don't forget the one thing to look out for: the cost of training staff in how to use that asset are never treated as part of the cost of the asset. They're always written off as an expense. Another important thing to remember about assets: if parts of the asset have different lifetimes and each part is a significant part of the overall cost of the asset, then IAS 16 says that the asset must be split up and each part of the asset must be depreciated individually over its own useful life. And if you can remember, we talked about the engines on a jet aircraft having a life that's considerably less than the airframe itself, and so we would have to split the cost of the aircraft between the airframe and the engines and depreciate each of them over a different period. And finally, depreciation. Do remember that it's nothing to do with reflecting the current value of assets in the balance sheet directly. The depreciation charge is supposed to represent the cost of the benefits that have been used up in the period. Nothing to do with the current value of the asset. It's the cost of the benefits that have been used up in the period. And remember, that can be either on a straight line basis if the benefits of the asset are going to be used up evenly over the lifetime of the asset. It's going to be on a reducing balance basis if the benefits are going to be used up more quickly when the asset's brand new than when it's really old. So that's something that needs to be considered as well. And remember, if changes are made to either the estimated life of the asset or the residual proceeds, then we don't go back and change the depreciation calculations that have already gone in past years. We simply take the carrying value, the net book value of the asset at that point in time, and then recalculate any depreciation charges from that point onwards. So here's a quick depreciation question. We purchased some machinery on the 1st of January 2018 for £24,000. We estimated a useful life of 12 years and a residual value of £6,000. We were going to depreciate it on a straight line basis. During the year ended December 2021, we realised that the machine was only going to last for 10 years, but after that 10 years we were probably going to be able to sell it for £10,000. Now see if you can work out what the depreciation charge will be for the year ended 31st of December 2020 and the 31st of December 2021 in respect of that piece of machinery. So just pause the presentation and see if you can work those figures out. So the original depreciation before the adjustments would be 24,000 original cost minus the residual proceeds of 6. That's 18,000 over 12 years on a straight line basis would give an annual depreciation charge of £1,500, and that's the figure that would appear in the 2020 accounts. The net book value at that date would be the original cost minus the depreciation for 3 years, the year to December 2018, 2019 and 2020. So the net book value at the start of January 2021 would be £19,500. That's the figure that we use to adjust the future depreciation. And so we need to recalculate the depreciation now. And so the charge for the period to December 2021 will be the carrying value brought forward of 19,500 less what we now believe to be the residual value of 10,000 over the remainder of the 10-year life that we now think the asset has. 3 years have already been used up, so there's 7 years left. And that will give us a depreciation charge now of 1,357. And that's the figure that will appear in the profit and loss account for 2021 in respect of this asset. So we don't change what's gone before. We take the net book value, the carrying value of the asset, and then rework the depreciation, the future depreciation charges from that point onwards. IAS 16 also allows for the upward revaluation of assets if we think they're worth more than their carrying amount. Remember that all assets of the same class must be revalued. If you've got a number of corner shops, you can't revalue just one, you have to revalue all the corner shops. If you've got a fleet of delivery vehicles, you can't revalue just one, you have to revalue the whole fleet of vehicles. All assets of the same class must be revalued. And the valuation for this purpose is based on effectively the market value of the asset, what it could be sold for in the open market. For this purpose, the value in use isn't used. And do remember there's got to be a double entry. We're going to increase the value of property, plant and equipment in the statement of financial position. So it's going to be a debit to that item. And there's got to be a credit, and that will go to the revaluation reserve, which will be part of the equity section of the balance sheet. And do remember this final point when you come to prepare the statement of comprehensive income, which includes the profit after tax for the year. We've also got to include the increase in the revaluation reserve as part of that other income. It's anything that's affected the equity total in the business goes as other income. That's apart from increases in share capital. Now, one thing to watch out for in the exam, if you've got a revaluation of anything other than land, is the date on which the revaluation occurred, because it's easy to make a mistake with that. If the revaluation was at the start of an accounting period, right at the start of the year, then you need to make your adjustments based on the carrying value brought forward, and the depreciation charge for the year, if there is one, the depreciation charge will then be based on the new revalued asset amount. If the revaluation is at the end of the accounting period, then you need to remember that you've got to include a year's depreciation based on the carrying value, net book value brought forward, before you then make an adjustment for the revaluation. Watch out for that. It's easy to forget that extra year's depreciation charge that needs to be put through. But remember, if it's land that's being revalued, it's the only tangible asset that's never depreciated. Everything else will be depreciated, but never land. And consequently, the date of the revaluation won't really make any difference to the adjustments required in that case. So here's a couple of quick questions just to emphasize that point. X Limited's preparing accounts to December 2020. On the 1st of January 2020, so that's the beginning of the year, a building that was being depreciated at 2% with a net book value of 200,000 was revalued at 240,000. Now in this case the adjustment is right at the beginning of the year. So see if you can work out what the depreciation charge for the year ended 31st of December 2020 will be. And this charge will be based on the new value of 240,000. So the depreciation charge for the year will be 4,800. See if you can now work out what the net book value will be, and that's fairly easy. It's going to be the revalued amount minus the £4,800. And what will the balance sheet revaluation reserve figure be? Well, the net book value was 200,000. We're revaluing it to 240,000, and so the revaluation reserve will show the increase of £40,000. Have a look at this one. The accounts are to December 2020, but this time the revaluation was on the 31st of December 2020. And the building was being depreciated at 2% on a straight line basis. The original cost was 300,000. The carrying value at the start of the year was 200,000. And it's been revalued at the end of the year at 240,000. See if you can work out what the depreciation this time will be for the year ended 31st of December 2020, and just pause the video to do that. So this time the charge will be based on the old value. You need to include an extra year's depreciation based on the original figures. So that will be 2% of the 300,000, which is £6,000. Just work out now what the net book value before the revaluation will be at the end of the accounting period. Assume that there's no revaluation going to be taking place. Work out what the net book value will be on that basis. Pause the video to do that. So the net book value at the start of the year was 200,000. An extra £6,000 depreciation has been put through, and so at the end of the year the net book value is going to be 194,000. We now need to work out what the net book value will be at the 31st of December 2020 after the revaluation has taken place. And because the revaluation is at the end of the year, that figure won't have been depreciated. So the carrying amount, the net book value, will be the whole 240,000. But what will the balance on the revaluation reserve be this time? Just pause the video and think about that for a moment. The important thing to remember here is that an extra year's depreciation has been charged before we've revalued the asset, and so the net book value at the time of the revaluation now is the 194,000 that was at the end of the year. So the revaluation reserve will show the difference between that revised net book value and the 240,000. So it won't be 40,000 this time, it will be 46,000 because of the additional 6,000 depreciation charge that was put through. So do watch out for that if you've got a revaluation of an asset that's being depreciated. If it's at the start of the year, if the revaluation's at the start of the year, then make the adjustments and then work out a year's depreciation. If the revaluation's at the end of the year, work out an extra year's depreciation first before you make the revaluation adjustments. IAS 36 is a really important accounting standard dealing with impairment. It's unlikely that it won't crop up in the exam. Remember that directors are obliged to carry out an impairment review whenever they know or should have known that assets in their balance sheet are worth less than the carrying amount. The only exceptions are intangible assets that aren't being depreciated or amortized every year, goodwill in particular, and in that case an impairment review must be carried out every year before the accounts are finalized. There's no requirement for the directors to think that it's been reduced in value. An impairment review must be carried out each and every year for goodwill. And remember, we cannot show an asset at more than the amount of the future economic benefit that the business is going to derive from that asset. And that future benefit is going to be one of two things: either what we can sell it for, and remember in this case we deduct any selling costs from the selling price, and that's not the same as the revaluation under IAS 16. Under IAS 16, if we revalue the asset upwards, we simply use the market value, but in the case of an impairment review, we deduct any selling costs from the market value of the asset. That's the fair value less costs to sell figure. The other way we can get a future benefit is to keep the asset and use it to make future profits, and that's the discounted present value of those positive cash flows that the asset's responsible for, at least in part, generating. So provided the current value, provided the net book value is no more than the highest of those two figures, no adjustments necessary. It's only where the carrying amount is less than both of those figures that we need to make an adjustment. And we write it down to the maximum future benefit that we're likely to receive. So here's a quick question. We've got a specialised piece of equipment with a carrying value of £180,000. It's a special piece of equipment and we can only sell it for scrap with a value of £90,000, but the company estimates that if the asset's kept and continues to be used, it's going to generate future profits of £195,000. So what adjustment is required in this case? And the answer is no adjustments required at all, provided the carrying value, provided the current carrying value of 180,000 is no more than either of these two figures, then we don't need to make an adjustment. It doesn't matter that the fair value less costs to sell is 90,000, provided the maximum future benefit we're going to get of 195,000 is at least as much as the carrying value. We don't need to make any adjustment whatsoever. Have a look at this case though. Similar piece of equipment, carrying value of 180,000, scrap value of 90,000, but this time the company only estimates that the present value of the future profits that piece of equipment is going to be responsible for generating is 115,000. In this case, the adjustment needs to be a reduction in the value of the asset from 180,000 down to a figure that represents the maximum future benefit that we can get, and the maximum future benefit's 115,000. So we need to reduce the value of the asset in the balance sheet by 65,000. Got to be a double entry, and that £65,000 will be reflected in an impairment loss appearing in the profit and loss account. If you're just preparing the balance sheet statement of financial position and you need to make this adjustment, remember the double entry again. The 65,000 impairment loss will need to be deducted from the retained earnings figure. Now, IAS 37, the one thing to be aware of is that IAS 37 does not deal with liabilities as such. Liabilities are defined in the conceptual framework, and provided that there's an obligation at the date of the balance sheet, provided it's more likely than not that that obligation is going to result in an outflow of economic benefits, and provided we can accurately measure the amount of that outflow, then we must include that liability in the balance sheet statement of financial position. So that's in the conceptual framework. IAS 37 only deals with provisions and contingent liabilities and contingent assets. And remember, the definition of a provision is something that's definitely a liability according to the definition in the framework, but it's uncertain either when we're going to have to pay it or exactly how much is going to be payable. So that's a provision. And nothing in particular there. That has to be included in the statement of financial position because it's definitely a liability. We're just uncertain about various aspects of it. A contingent liability, however, must be something that we've got an obligation in respect of at the date of the balance sheet, at the date of the statement of financial position. There's got to be some obligation, legal or constructive. If there's no obligation, there's no liability. Remember, in one of the mock exams we looked at, there was a dividend that was declared after the year end. Until that dividend's declared, there is no obligation to pay it, and so there's no liability at the balance sheet date. If the company is thinking about making employees redundant and the redundancy notices aren't issued until after the year end, there's no liability for the redundancy that needs to be included in the balance sheet, because the directors could change their minds between the date that they decide to make people redundant and the date that the letters are issued. So there's got to be an obligation at the year end for there to be a contingent liability, but it's unlikely that a payment will have to be made. So it's more likely than not that the payment will not have to be made. It's still an obligation, but we don't think it's going to involve an outflow of economic benefits. In this case, we don't include it in the statement of financial position, but we must include a note about it in the accounts if it's material and if it could affect a potential investor's investment decisions. So a contingent liability, there's got to be an obligation still, but it's unlikely that that obligation is going to result in a payment out of the company. Some examples that might crop up of liabilities: if there's an ongoing court case and if we think we're going to win the case, if it's more likely than not that we'll win the case, then a payment's unlikely, and that means that it's a contingent liability and we need to make a note in the accounts. If we think we're going to lose the case, then it's probable that there will be an outflow of economic benefits, and in that case we need to include it as a liability in the balance sheet. So it's all a question of whether we think it's likely that a payment will be made or not. If we think we're going to have to make a payment, it needs to be a liability in the balance sheet. If we think it's unlikely that a payment will be made, it's a contingent liability. But there's still got to be an obligation at the balance sheet date. Another example that I've mentioned before, parent company guaranteeing the loan of a subsidiary. Whether it's a contingent liability or an actual liability that goes in the balance sheet will depend on the position of the subsidiary. If the subsidiary is trading profitably, then it's likely that it's going to continue making loan repayments, and payment under the guarantee is therefore unlikely. Therefore, it's a contingent liability, and we don't include it in the balance sheet, but we disclose in a note to the accounts the fact that that obligation exists. If, however, the subsidiary is making losses, it's got cash flow problems, then it's more likely than not that the parent company will have to make a payment under the terms of that guarantee. And in this case, if it's probable that there will be an outflow of economic benefits, we must include it as a liability in the balance sheet. So there's got to be an obligation in either case. There's got to be an obligation in either case. But whether it's a contingent liability that we include as a note, or whether it's an actual liability that needs to be included in the balance sheet, depends on how likely it is that we're going to have to make a payment. Now, contingent assets are dealt with very differently because we're always cautious about including assets in the balance sheet. And a contingent asset's an asset that may give rise to an inflow of cash or benefits, but it's uncertain. A contingent asset is never included in the balance sheet, even if we think it's likely that we'll receive a payment where the decision regarding that payment depends on someone outside the company making a decision. So it might be an ongoing court case where the judge will decide whether we're entitled to receive a payment or not. And even if we think we're going to win, we won't include that as an asset. So this is different treatment to a liability. We must include the liability if it's probable that we're going to have to make a payment. But we don't include an asset if we think it's probable that we're going to receive some money. We only include that asset if we're absolutely certain that that cash will be received. IAS 38 deals with intangibles. Remember the definition, you sometimes get asked for it. It's an identifiable non-monetary asset that has no physical substance. And it's something that's going to provide us with future economic benefits, and it's something the cost of which can be reliably measured. And it's that final item that precludes the inclusion of internally generated goodwill, because we can't reliably come up with a value for that internally generated goodwill. The main item that's likely to crop up in the exam under IAS 38 is research and development costs. Remember, research costs always written off to profit and loss, never capitalized. Development costs are put to the balance sheet if all of the conditions are met. There's got to be some future economic benefit as a result of the expenditure. The company is going to complete and use the item or sell the item that's been developed, and it's going to sell it at a profit. The company's got sufficient resources to undertake that production and sale, the expenditure on development can be reliably measured. So all of those items are requirements that have to be met before we capitalise development costs. If any of them are not met, if the company hasn't got sufficient resources yet, because it still needs to go and raise more share capital or loans from the bank, then we can't capitalise the development cost. It has to be written off to P&L. But once it's capitalised, we then write it off over the life of the asset or the product that's going to be produced. If we develop a new type of I don't know, office machine, and we think that that's going to be a saleable product for the next 5 years, then the development costs need to be written off over that 5-year period. Now, in the case of leases under IFRS 16, I've done some slides on that. One thing I just wanted to clarify is the situation where payments are in arrears or payments are in advance, because it's the advanced payments that sometimes cause a problem. In this example, the payments are in arrears, and that implies that the payment will be made right at the end of each accounting period. In this example, we've got a lease over 4 years, and each payment is going to be at the end of the financial year. In this case, where payments are in arrears, all 4 of those payments will be discounted to a present value, and that will be the value of the asset that you'll debit to property, plant and equipment. The first payment that's made at the end of year 1, that payment will include the payment of the interest charge for year 1 that you'll probably work out on an actuarial basis. The payment in year 2 will include payment of the interest charge for year 2, and so only part of that payment represents a repayment of capital, and it's only that part of the payment that should be shown as a current liability. The rest of the outstanding amount will be shown as a long-term liability. So that's payments in arrears. That's fairly straightforward, and I think people are okay with the calculations there. Remember, the asset must be depreciated over the period of the lease. Even if the asset's got a useful life of 10 years, it must be depreciated over that 4-year period. Payments in advance are a bit more confusing. Here we've still got a 4-year lease, but the payments are in advance right at the beginning of the year. In this case, the first payment is treated as a deposit payment, and it's only payments 2, 3 and 4 that are discounted to give a present value. Now, in this case, when we work out the amount of the asset that we're going to debit to property, plant and equipment, we need to take the present value of those payments and add to them the amount of the deposit payment. So it'll be the discounted value of payments 2, 3 and 4 plus the deposit payment, payment number 1. And if the question gives you a present value, it will only be a present value of payments 2, 3 and 4. Now, in this case, the second payment that occurs right at the start of year 2, that payment will represent the capital repayment for year 1 and also the payment of year 1 interest. And in this case, the whole of that second payment will be shown as a current liability in the year 1 statement of financial position, because it includes the accrued interest for year one. So with payments in advance, we know when we come to produce the year one balance sheet, statement of financial position, we know what the current liability part of the outstanding amount is going to be. It's going to be the total of the payment that's going to be made in year two. And as you'll see, there's no interest charge in year four, because we've effectively, if we're treating the amount outstanding as a loan, the loan is going to be repaid right at the start of year four. So there isn't going to be an interest charge for the final year of the lease. Question 6 will inevitably be a consolidation question. These days, it's less likely that you will have a full balance sheet or a full profit and loss account that you need to produce. More often than not, you will be asked to simply calculate the goodwill and maybe the non-controlling interest figure that appears in the statement of financial position, rather than produce a full set of accounts. But one way or another, those calculations will appear in this section of the exam. So some quick notes about the consolidated profit and loss. Just remember the overall rule that all intercompany transactions need to be eliminated. Anything that wouldn't be there if it was a single company needs to be taken out of the consolidated profit and loss. So intercompany sales and purchases, obviously. Interest paid and received, if there's an intercompany loan, it will be shown as investment income, and finance costs. Both of those need to be eliminated. And if dividends have been received by the parent company from the subsidiary, that needs to be eliminated as well. There won't be a double entry here, because the payment of the dividend won't be included in the subsidiary's profit and loss account. It goes straight to retained earnings in the balance sheet. So those are the things to watch out for in terms of intercompany transactions. There will undoubtedly be an adjustment required for unrealized profits where stock's been transferred between companies within the group. When you're working out the unrealized profit, make sure you don't confuse gross margin and markup if you need to calculate that. Gross margin tells you the percentage of the selling price that represents the profit. Markup represents the percentage of cost that's added on to cost to get to the selling price. So if the markup is let's say 20%, then the selling price represents 120% of original cost. And so you can work out from that how much of the selling price represents profit. So don't confuse those two. But remember, it's only the profit on unsold items that needs to be eliminated. If there's been an intercompany transaction and the goods have been sold on to a third-party customer, then there's no need to make an adjustment, apart from cancelling out the purchase and the sale as normal. And do remember this final point: the adjustment is going to reduce closing stock, which means it's going to increase the cost of sales figure. So you add it on to cost of sales, it's going to reduce the profits in the consolidated profit and loss account. The other thing that's important to remember with the apportionment of the consolidated profit is that the non-controlling interest in the subsidiary, those shareholders are only entitled to a share of the subsidiary's profit that's included in the consolidation. Don't make the mistake of working out a percentage of the total consolidated profit. We're only interested in them having a share of the subsidiary's profit, and most importantly, it's the subsidiary's profit that's included in the consolidation, not necessarily the profit that's shown in the subsidiary's profit and loss account. If intercompany sales were from the parent company to the subsidiary, then no adjustments necessary, and we can use the profit figure shown in the subsidiary's accounts. But if there are intercompany sales from the subsidiary to the parent company, and we've needed to make an adjustment for unrealized profit on stock, then that unrealized profit adjustment needs to be deducted from the subsidiary company's profit figure before working out the non-controlling interest share of the profits included in the consolidation. So just watch out for that. Now, the statement of financial position, the balance sheet, most is fairly straightforward, but do remember when you're calculating goodwill that the figure to include is the retained earnings of the subsidiary at the date of acquisition, not the current retained earnings figure from the balance sheet. And remember, if there's an impairment of goodwill and you have to reduce the goodwill figure that you put into the consolidated balance sheet, remember there's a double entry. The same amount needs to be deducted from the retained earnings figure in that consolidated statement. Non-current assets, remember to add the fair value adjustment to the balance sheet values shown in the individual accounts. If there's a fair value adjustment because the subsidiary is showing the asset at original cost and it was worth more than that when we purchased the shares, then that difference needs to be added to the balance sheet figures. If there's a stock adjustment, remember there's a double entry again. If you're reducing the inventory in the balance sheet, then you've got to reduce the retained earnings figure as well. And share capital and share premium, easiest marks in the question. Only the parent company's share capital and share premium, the only ones that ever appear in the consolidated statement. Now, as I've said previously with the consolidations, it can be confusing if you try and work from the workings boxes that are included in the exam, because the figures could be shown in a variety of ways, and I would always recommend that you work out the calculations on scrap first of all in a way that you're familiar with. And I would always recommend the calculation that's used in the total column here, where you work out first of all what the balance sheet total of the subsidiary would have been at the date of acquisition. So we take the subsidiary share capital and share premium account, and the retained earnings, not the current retained earnings figure, but the retained earnings at the date of acquisition. That will give us the total balance sheet value of the subsidiary. Add on to that any fair value adjustment if the assets were worth more than their balance sheet figure. That gives the value of the total of the company at the date of acquisition. If we've purchased less than 100% of the shares, we then need to make a deduction for the non-controlling interest. That gives a value for the part of the company that we've purchased. If you compare that to the price that we've paid, the difference is the goodwill. Now, sometimes in the exam, you'll be given a box that is equivalent to what's in the parent company column here, where you only show the parent's share of the share capital, share premium and retained earnings, and the parent company's share of the fair value adjustment, and then compare that total with the price paid to get the goodwill. The figures will always be the same, so work out in a way that you're comfortable with what the goodwill figure is, and then try and fit it into the boxes if you want to, but don't worry too much about that. And finally, ratios. I've produced quite a few videos on ratios that you might want to have a second look at, but here's just a couple of notes to help with those questions, particularly question 8, where you have to comment on the ratios. Make sure you write comprehensively when you come to answer that final question. The first mock exam contains a good example of that written question with suggestions as to the type of answers that you could give. So you might like to revisit that as well. Ratios, I've already produced quite a few videos on those. So just a couple of things I want to mention. If you're not sure of the formula, and sometimes in the exam you'll be given 1 year's ratios and asked to calculate the similar ratios for the second year. In that case, you can check that you've got the correct formula by recalculating the ratios that you're already given from the accounts that you're provided with to confirm that your formula is correct. The other important thing is question 8, the written answers on ratios. I would suggest that you always, first of all, explain the change in a particular ratio from 1 year to another, and then say whether the change is an improvement or a deterioration, and why, what effect it's going to have on the company and the company's profits or the company's working capital. Then suggest reasons why the change might have occurred. You're unlikely to be given sufficient information in the question to actually identify the reason, but just make suggestions. And do remember, when it comes to revenue, do not make the mistake of saying that that the gross margins improved because we've sold more goods. That will not affect the gross margin at all. Selling more goods or selling less goods won't affect the gross profit percentage. It's only if the selling price changes or the cost of those goods changes that the gross margin is going to be affected. So suggest reasons why the change might have occurred, and finally any action that the company might take as a result. So if, for example, the receivable days has deteriorated, if customers are taking longer to pay, then the company should review its credit control procedures and so on. And if you cover those 4 points in the written answers, then you should do reasonably well in terms of earning marks.